Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Moore's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Moore who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with Rob Campbell, Institutional Portfolio Manager, on the concept of something called suitcase words. Words that can mean different things to different people. From an investing point of view, Rob uses the word defensive to illustrate how many meanings can be packed into one concept and the importance of having a process where shared understanding is key.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
In this episode, you get two institutional portfolio managers. That's my role at the firm. So Cam's an institutional portfolio manager, and Rob Campbell is. He works out of Toronto, and I work out of Calgary. We're here to talk about something called suitcase words. But before we get there, Rob, just give us a little background on you and how you ended up as an institutional portfolio manager at Moore.
Sure. Well, first, thanks for having me on the show. I'm a big fan.
Woohoo!
I'm actually relatively new to Moore, so I've been at the firm for about 2 years. And I don't know what's most relevant about me. Maybe that I got into the industry around 2008 or 2009. So right in the depths of the financial crisis, which I think means two things.
That was your first job?
First job out of university was
I have a good story
right around
too
that time.
About first job. My first job?
What was that?
The day Briax broke.
Oh, wow.
I was on a trading floor that day. That was wild.
Yeah, so I think these things sort of shape your outlook on things. But the one I think I'm more worried about is having started, sort of in early 2009, I've basically only known a bull market. I haven't really seen a real correction, at least something I haven't read about in a book or, before getting really involved in the industry. So when I think about, I guess, my personal portfolio, one of the things I'm always wrestling with is I think I have a high risk tolerance, but it's never really been tested. Never actually put it to the test, and hope I don't have to anytime soon, but you never know. Okay,
so your only career experience is a bull market.
A growing number of people in the industry, by the way.
Oh, yeah. No, I think it's actually a generation. There's been a generation of people that have not experienced a bear market, right? So when the proverbial hits the fan, maybe that'll be a shock, or there'll be people who go through their whole investing careers and not see a bear market. That's a possibility too.
Hey, let's hope. But
yeah, there you go.
Probabilities would say probably not.
Okay, that's a good introduction, so thanks for that. What we're here to talk about is something called a suitcase word. So First of all, Rob, why don't you give us a sense of what that means? Okay,
so a suitcase word is a word into which people pack multiple meanings. So you think about a suitcase, you put in, I traveled to Calgary and I actually packed this morning. But, I threw in my shirts and my socks and things like that.
Yeah. So you put a dictionary in there?
No.
Oh, okay.
Thesaurus maybe. But, it's really one in which, people ascribe multiple meanings. And the term itself was coined by a guy named Marvin Minsky. And Marvin Minsky is actually a really interesting character. So he's one of the legends, I guess, when it comes to artificial intelligence. So one of the real pioneers, one of the very early winners of the Turing Award, named for Alan Turing, who's another, sort of legend in the world of computing. He founded the Artificial Intelligence Lab at MIT and has really been this visionary very early on when it came to applying computing power to all kinds of different things. I think at his core, Minsky was a cognitive scientist. And the reason that he came up with this term suitcase words is, really, if you think about artificial intelligence, and if you think about the Turing Test, the Turing Test is something that Alan Turing essentially was a test to see, if maybe a good example is if you ever get calls from telemarketers in the evenings. Yeah. Well, one time I picked up the phone and I actually asked the guy, "Are you a robot?" Just because his delivery was so robotic. And I think I really insulted him because he sort of said, "No, do I sound like one?" But the Turing Test is the sign of true artificial intelligence is, can a rational can a human determine whether they're speaking with another human or with a computer? And that was sort of the Turing Test. And it feels like we're kind of getting closer. But Marvin Minsky's work was really about breaking down these insanely complicated processes that we call intelligence or the functioning of the human brain. And it was his belief that you could really break that down into these very discrete, possibly millions of processes that make up what we call intelligence or consciousness or learning or emotion, things like that, pretty early on in the realm of computational science. But I think it was his, and he's recently deceased, but I think it was his vision that, 50, 100 years from now, we might actually have the tools to be able to do that. So why does it matter for suitcase words? Well, he thought that one of the real obstacles to figuring out what consciousness was is that, everybody sort of ascribed different things to this word consciousness as an example. So, are you conscious of what you did yesterday? Are you conscious of how you made that person feel? Consciousness is this quasi-religious type thing. This word consciousness is used to represent all of that. And when faced with something so complicated, I think a lot of people just sort of throw up their hands and say, well, we can't define this. It's too complex. It's something about the human experience that's irreconcilable or we just can't break down. So let's sort of give up doing it. And Minsky's view was, well, no, we shouldn't just give up because something's complex. We should actually try to figure it out.
So what I'm thinking right now, Rob, is for listeners, now that we've defined what a suitcase word is do word association. You and I will go back and forth. So I'll give you a word. You tell me what you think it means. I'll tell you what I think it means, and we'll see if we're
let's do it.
Building the suitcase. So one that comes to mind that's really easy. Canadians like to talk about the weather a lot. So it's nice outside. Nice.
Yeah, my wife and I have different views on this. For my wife, nice is, being on a beach somewhere a lot further south. From my perspective, being uncomfortably hot. For me, it's, a nice fall day. That's sort of nice weather. But again, two people can have very different definitions of what nice can mean.
Okay. I'm not going to answer that. Now I'm going to throw it back to you. You give me a word and
I'll give you a challenging one.
Ooh.
Like what is love to you?
Oh, my goodness. Wow. Well, different levels. Like personally, I can think of multiple meanings, right?
But I think that's the point, right? Another example might be something like social justice. You might say, and I might say, and we might agree that the world needs more social justice, or we need more social justice here in Canada. But, for one person, that might mean, having more welfare programs and a larger social net, a more redistributive tax system, a more progressive tax code. And for the other person, it actually might mean the entire opposite. But if we just sit here and we agree, yep, the world needs or Canada needs more social justice, we might actually be seeing diametrically opposite things. And if we don't take the time to sort of unpack those words, then we run into potentially trouble, or at least some pretty serious misunderstanding.
So if you and I are trying to have a conversation about social justice, but we don't understand our points of view, so maybe back to the cognitive, what cognitive space am I in, then we're not going to have a very productive conversation, right?
That's right. My wife might say, can you clean the dishes? And I'll scrub them and put them in the rack to dry. And to me, that's having cleaned the dishes. For her, she maybe meant, can you also dry them and put them away? I will have said, sure, I clean the dishes. And, she might think of it a different way. So
let's get listeners thinking a little more about investing. So quickly thinking, the industry puts tags on a lot of stuff. And we all, I guess maybe some investors get caught in that trap. So really good example is value, right? So I'm a value investor. Well, what is a value stock? That's a suitcase word in itself, or a suitcase bucket in investing. Value. Flip it around. Growth. Mid-cap. Small cap. Small caps can become large caps. Large caps can become small caps. Thank you, BlackBerry. Things like that. So in investing, let's investigate how we at More actually look at suitcase words. How do we get to those conversations where we're understanding one another when we're speaking about something, and maybe we'll focus on one particular area that may be changing in investing, and that's, what does defensive mean? So what if you want defensive qualities in your portfolio, is that a suitcase word, or do we all understand what defensive means?
Yeah, I mean, I actually think if you think about it, pretty much every word in the English language is a suitcase word. Probably the best example of that is if you sort of think back 20 years ago when President Bill Clinton had his troubles with Monica Lewinsky. And I sort of remember at the time listening to this and thinking, this guy's crazy. But he was making the argument, and I forget what the quote was exactly, but he said something like,
It depends on
it depends on what your meaning of the word is. And this was a legal defense of, whether or not he had lied, I guess, to the American public, or I can't remember exactly what.
Some lawyer got paid like $30,000 to just go and argue that depends what the meaning of is.
Well, and it seemed like a pretty important point. And I just remember thinking that's ridiculous. But the verb to be is a suitcase word. If I do a little bit of writing, and he asked if I had a dictionary in my suitcase, but I am a serial user of thesaurus function in Microsoft Word, and you can basically look up any word, and there's a long list of definitions or of synonyms to
Shift F7.
Word. Shift F7. That's exactly it. All of them, they mean the same thing, but they're all a little bit different too. Again, that's sort of each one of those synonyms fits in on this idea of a suitcase word. So yes, I think there are massive amounts of suitcase words in investing. And I think where you're going with this is, where do we have the potential as investors to go astray if we rely too much on, or I guess presume too much about what we mean by a certain word?
Yeah, absolutely. So Rob, let's talk a little bit about how we at More avoid multiple meanings in important words in our investment approach. So why don't you describe to us how you and I understand, because we both deliver this message to clients, so we're not speaking directly day to day how we use this, but maybe you and I can get that message across to listeners as to how we talk to clients about process.
I challenge you a little bit, I think, in the sense that I don't think that we try to avoid them. One of sometimes the best insights come out of people who have two different approaches to a problem, or two different mental models how to think about something, and then getting those people together to talk about it, in our view, I think leads to often really great conversations and good insights. So I think one of the things that we've done as a team is we've tried to foster a team where we do have this cognitive diversity, or people from various backgrounds who might bring different views to a potential issue, whether it's the defensive characteristics of a stock, or what represents value. Yeah, so having those various viewpoints come together, I think, is important. But I think it's also important that once we do realize that there's the potential for dissonance, or for a difference in interpretation between two things, that we actually take the time to define it, so that we can be speaking a common language. And so that when, somebody says, yeah, I think this stock has some really great defensive characteristics, that's not misinterpreted by somebody else. What does that actually mean? Let's dig into what actually makes a stock defensive. And again, it's not the truth. Other groups can have different ways of thinking about it. But to avoid this idea of just crossing our signals, let's take the time to define things that we think are important.
Okay. What would the defensive qualities be about MasterCard? Well, it's transaction-based. It's a global electronic transactions are growing and growing. This company's growing at 15, 20% a year in earnings. That's different than, say, a utility that grows at 3% a year and pays a 5% dividend. Yet the investing world says, well, MasterCard's a growth stock and the utility's a defensive stock.
Sure. And you talked about, small cap, large cap, and growth value. There are these style boxes, right, where I think Morningstar uses them. We probably want to check that. But, you can plot every fund or strategy onto this sort of 3x3 grid. And all of a sudden, someone's made a decision that, well, that's just the type of investment strategy is. I think those things are useful too. And maybe I'm digressing too much here, but because it's a heuristic, and heuristics are pretty important as well. If I come across a tiger, I probably don't want to spend my time trying to figure out which of the 9 different types or species of tigers I'm actually facing. I probably want to get the hell out of there.
Yeah.
So this idea of heuristics and sort of these mental shortcuts, they are useful. It's just when that they introduce some confusion, or whether it's unintended confusion or just confusion that people aren't aware of, that's where they can become.
So we were talking a little bit about cognitive diversity and how, wide, maybe at the onset, there's wide variance in terms of definition or people's perception of the same thing. So it's same word, same company, same industry, same sector. What other tools does the team use to kind of get on the same page?
But I think one thing we didn't mention earlier that's really important about that is cognitive diversity is worthless if you're in an environment where you don't feel like you can speak up. So having a culture within the firm where everybody's opinion is valued, everybody feels that they're in a safe place to express their views, is really important to being able to harness that cognitive diversity. Otherwise, it sort of goes out the window if everybody keeps their opinions to themselves because they're worried about, being judged or making a mistake or something like that.
Or the structure's hierarchical.
Yeah, and it doesn't mean that it can't work in a hierarchical structure. Just the way, we've thought about it is, put people in a pretty flat environment, you'll be able to foster that cognitive diversity. So that's, I think, one important piece that's worth mentioning. And then the other is, this idea, and we might have talked about it in prior podcasts a lot, is this idea of really trying to separate between what is opinion and what's actually fact. And it's incredible how often the two sort of get confused. So it's actually entered into the vernacular of the way that we speak to one another. When presenting an opinion, or we'll introduce our comment by saying, well, my story is, and then present, I think this is a wealth-creating business for these particular reasons. And so that's one piece of it. So separating between the opinions and the facts. It's not uncommon for somebody to sort of challenge somebody else if they've presented something as fact to say, well, that's just your story. And I think those behaviors are sort of important to, again, having that open culture. And then connected to that, I guess, is, well, trying to collect as much that we can in terms of facts and data to actually back up and to provide some proof behind something that we actually put forward.
Why don't we, Rob, dig into the weeds a little bit? I think listeners now know that Cam likes to get in the weeds. I won't go too far in this question, but what we want to do is investigate the word defensive. So maybe we can start with, you entered the industry and just after the downturn, do you even know what a defensive stock is?
I don't think anyone can really know or say with certainty. But I think the reason it's such an interesting word to talk about today is, just where we are, 9 years into the current equity market with valuations sort of where they are. I think in my interactions with clients, a lot of questions I'm getting really are centered around valuation. Clients are sort of worried about, a lot of the gains that they've enjoyed over the past 9 years. How sustainable are they going forward? What can they expect the next 5 years?
Yeah, these are clients with gray hair like me, most likely.
Sometimes, but I think it's top of mind essentially. So I think just a really interesting word to explore right now.
But what's their definition of defensive?
Well, I think they're all different, right? There are clients who think being defensive means holding a lot of cash. And that's when they ask me, are you getting more defensive? Really, that's when you dig in a little bit, that's what they're asking. Are you holding more cash in the portfolio? Other clients, it's about the particular attributes of stocks that we hold. Are we shifting to a more defensive posture? For some clients, that means, are you loading up on utilities and telcos and consumer staples and these sectors that historically have, you go back sort of 50 years, and over the last 8 recessionary periods in the U.S., the consumer staple sector has always outperformed during those recessionary periods. Yeah, it's probably a good way of thinking about defensiveness, an investment that retains its value through periods of market strife. So that's, what they're asking about. Really, they're asking from a sector perspective. And yeah, there might be some overlap in terms of the way that we think about that as well. But, we're really fundamental bottom-up stock pickers, essentially. And so we're looking at the portfolio, stock by stock. And I think that's where most of the conversations around defensive, at least internally within the research team, are coming from. What is it about a particular business model that might be more or less defensive? What is it about valuations that might lend themselves to something being more or less defensive? And then what might it mean in terms of what we might do in portfolios?
Okay, so we have the client perspective of a couple of perspectives from clients on what defensive means. Could be cash, could be in type of securities you own in the equity portfolio. Have we at Moore come to a conclusion as to what defensive means?
So yes, when we unpack the suitcase, it comes back to a few things that are really tied to our investment philosophy. So it really starts with the business model. And that's, we're looking at companies on a case-by-case basis. What are the characteristics of the business model, the industry that it competes in?
So it's irrespective of the sector. We're not doing top-down.
That's right.
Here are the defensive sectors, and we'll look at companies in these sectors. It's
absolutely.
What's the business model?
Yeah.
Okay.
What's management like? Are they stewards of capital? Are they effective stewards of capital? And so from this, I think when we define what a defensive business is, it's really one in which the cash flows that are generated by the company are both recurring and they're durable. So recurring...
another suitcase for durable.
Yeah, so recurring meaning, if you think of a business model where it's sort of subscription. So, we don't hold Netflix, but it's somewhat similar. You sort of pay
$9.99 a month or whatever it is.
Yep. $9.99 a month, and you pay that every month. So those are sort of recurring revenues.
Mm-hmm.
And the durability of those revenues are, well, how sure can we be a year or two from now that those will still be there? And so that's really the two qualities of a defensive business are the recurrence and the durability of the business model. I think it's fair to say that historically, there probably are a lot of companies in the consumer staples sector that have met that definition. So if you think about a company that makes toothpaste, well, whether we're in this period of strong economic growth or of a really strong downturn, I would hope at least that most people are still brushing their teeth. That's probably not where you're sort of gonna pull back.
You might pull back on the Crest white strips that cost $80 a box, but okay.
Maybe. But the toothpaste itself, historically that's probably been a little bit more durable than some large capital expenditure that other businesses might be more.
Oh, that's a great example. Yeah.
I was going to say that's one piece. It's the business model, and I think we really start there. It really starts with the business model, but then if I purchased a really defensive business model at a price that doesn't make a lot of sense, well, all of a sudden I invite a lot of downside risk to that investment. And I think that's tied to the way we think about risk. So there are a lot of ways to define risk as a suitcase word. A very common one in terms of what clients sort of look at is, well, what were the standard deviation of my returns? So the larger the variance in terms of returns, well, that's probably a little bit more risky. The more volatile things are, more risky. That's really not the way that we think about it. We don't think of risk as the day-to-day movement in stock prices. Risk for us is what we call permanent impairment of capital. So what is the probability that capital gets impaired so much that our ability to recover that over a period of time, the probability of that becomes really low? And so you've got to tie these two things, the durability of cash flows with the valuation. And so something where the odds are a little bit more in your favor from a valuation perspective, that's also what we would define as being defensive.
Okay, so let's talk about two examples. One that traditionally would be characterized as defensive, but in our process and our analysis suggests maybe the cash flows aren't as defensible anymore as we thought. So Nestle comes to mind. Widely speaking, the consumer packaged goods players, the global players, are struggling with innovation, with product rollouts, primarily due to local competition and being able to kind of fast forward and gain share. So what's our conclusion around Nestle? Why don't we hold it? It should be a pretty defensive security, but why don't we hold it?
So we sold Nestle mid-2017, and really was a function of those two things that I spoke about. Nestle historically has been quite a good, I think you could probably have called it a pretty good defensive business.
Coffee, man. Nespresso every morning.
Exactly.
Mm-hmm.
But I think one of the things that's happened with Nestle, and it seems like there isn't a podcast where they're talking about Amazon. The shadow of Amazon is very long, and it's so easy today. I mean, the disintermediation and the disruption in the retail sector is incredible. It is very, very easy today for a small local competitor to get distribution. In the past, big companies like Nestle had very, very strong brands. You think of coffee, you think of Nescafe, you think of the brands associated with chocolate bars, which meant that consumers really knew about them, and they were able to get really great positioning on grocery shelves and things like that, and so the value of their brands were very strong. Because it's so easy for local competitors who are maybe a little bit more nimble to accommodate the various tastes in different countries. And because it's so easy to get a product on Amazon and get a couple of solid reviews and have people go there, it's just become a lot more difficult for companies like Nestle. A lot of consumer companies have actually seen their pricing power erode over the past year, which is the first time in a really, really long time, which I think speaks to some of the competition out there. They can't charge the same year-over-year increase in prices that they used to in the past. They're having to compete with more formidable competition. So from a durability perspective, we began to question just how durable those revenues were at companies like Nestle.
And the valuation at the time didn't speak to, there's a huge margin of safety here. So while these companies might be struggling, there's no high conviction on the return potential.
That's right. So a company like Nestle, if you think back to sort of 2007 or 2008, the peak of the market at that point, I think was trading around 14 times earnings. When we sold, I think it was somewhere near 35 times. So that's a very expensive stock. So when you think about both pieces, the resilience of the business model and the resilience of the valuation ultimately, it just sort of pointed to, well, gosh, maybe this company won't be as defensive as it maybe was. And I think the experience, and it's probably pretty early, or it's too early to tell, but we've come through a period through the first half of 2018 where volatility's really come back to the market. And I think that's sort of the time that you would expect those more defensive investments to hold up a little bit. And the experience has really been, and it's not just Nestle, but a lot of consumer staples companies, particularly the very strong brands that have really suffered so far this year, and they've underperformed. So I think it speaks to the danger of, saying, it's a consumer staples company. We can hold that pretty safely. It's a pretty good place to hide out. And it might be. We could be wrong. Just when we sort of go through our model and our thinking, it just stood out based on our definition of the word as something that was maybe worth stepping away from.
Okay. So on the flip side, what have we added to the portfolios recently that have the better combination of defensible recurring revenue and an attractive valuation?
Yes. They're really hard to find today. And I don't think it's because there aren't really great business models that have recurring revenues out there. I think in today's environment, it's more a function of the valuation piece, where we might come across a lot of great companies, but we just can't wrap our heads around the valuation and sort of have difficulty there, at least when thinking of the defensiveness of the investment.
Okay. But that said, there should be an example.
There should. I think one, and it's sort of counterintuitive in the same way that I think consumer staples are a little bit counterintuitive. I think we've been finding a lot of ideas within the industrial space of more defensive businesses. And maybe your heuristic, or when you think about industrials, are, well, these are pretty cyclical type businesses. The economy turns and they've got lots of fixed costs. They have all these factories and stuff like that. They're definitely not defensive. But industrials is a pretty big catch-all, just in the same way that any sector is a pretty big catch-all. And some of the ideas that we found in that space, one as an example is Wolters Kluwer. So Wolters Kluwer is a company based in the Netherlands, but their business is pretty global. They're essentially a company that provides a lot of reference material and software that's used by various types of professionals in the world. So think about accounting software that is used in the preparation of corporate taxes, or medical journals. So they publish papers. They're the ones who actually own the journals. So I guess when you think about the business model and the products that they offer, these are things that their customers really need. As a research scientist, you've got to stay on top of the latest research. As somebody filing taxes every year, you've got to have the most
there's
updated,
change in tax code.
Yeah, so changes all the time. So
gotcha.
There's these largely subscription based, which brings recurring revenues. A little bit less sensitive to the economy, in that even if things go south, people still have to purchase their products. I think this particular company, at least management, has done a very good job of transitioning a lot of their sort of legacy print business, if you think about in the journal space, over to digital.
So that would be a major risk to their traditional business.
Exactly.
Does that make it higher margin maybe too?
I don't know if it makes it higher margin, but what it does from a recurrence perspective is the revenues in the digital space are something like, the retention rate is 90 to 100%. So what that means is that customers will return every year to repurchase the same product, or maybe add on some additional products. So that's, for us, what makes it defensive. And then, okay, let's tie that to the valuation. Wolters Kluwer has done pretty well the last little while, so perhaps from a valuation perspective, it's not as attractive as it used to be. But there is a little bit more of that margin of safety associated with that stock. So what that means is, when we look through and we make our assumptions about the various scenarios that can unfold, there's a greater probability that we're purchasing the stock with a margin of safety than something like a Nestle.
Yeah, so Wolters would be outside the shadow of Amazon. Say right, they've got proprietary content that, from a regulatory point of view or a scientific point of view, is changing day to day. So you can't just list those on Amazon and distribute that way.
to the extent, Cam, that you think that anybody's outside of the shadow of Amazon.
This is true. Okay, I think we've done a great job of working through what a suitcase word is, how our research team approaches it, and a couple examples on both sides where traditionally defensive stock would have been in the portfolio is no longer, and now there's other things around that. So I want to wrap up our discussion, Rob, with one more thought. And what we do here is we usually ask the guests to relate something personal to how they apply it in investing. So I know you're a big rugby player in your was okay. So you're not playing anymore. So give us a sense of what you learned in rugby and how you apply that to your day to day.
Well, I actually think there are two things that are relevant to the discussion that we had. And I guess it's actually my favorite thing about rugby is there are not many other sports where you really depend so much on your teammates. I sort of, my mental model of basketball is, you can have LeBron James on his team, although maybe it didn't work this year. But one superstar can really add a lot to a team. And I think the beauty and one of the things I love about rugby is it's really about everybody. And so there are 15 players from each team on a field. All of them have different roles and responsibilities, different body types, different skill sets. And, it's about bringing that collective together with a common objective that makes for a successful rugby team. So I think that's one of the interesting things is just this need to have these various skill sets on a team for ultimate success. And then I think the other thing is I think of, both my own experiences playing rugby and the best seasons or the best teams I've been on, or, when looking at the world of, professional rugby, and I know you spoke to VJ about the All Blacks, which huge fan, is that culture really makes a big difference. So the All Blacks very famously, sort of around 2004, realized they had a culture problem, instituted a lot of reforms, passed down responsibility from the coaches onto the leadership group from a player's perspective, and really put it on the players to, adopt this philosophy of leaving the jersey in a better place. And they've had incredible success since then. And as I think back to my playing days, the best club I ever played for, I think one of the really strong reasons behind our success is that, we all hung out outside of rugby practices and really enjoyed practices and being on the field together. We're able to express ourselves, to the extent that we wanted to on the field. I think that culture played a big role. So I think as I think about our business and our team, those are two really important elements.
Fantastic. Well, I've really enjoyed having you on. Colleague, teammate.
Yeah.
Thanks for joining us in the podcast, and we'll have another conversation down the road, I'm sure.
I look forward to it.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.